Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, I'm going to take on another topic that I was previously discussing in one of my accounting lessons, and this is going to be bonds. Bonds, we had seen them as a way for companies to finance themselves, and this would belong into their debt part of the financing. Because bonds can be issued by either corporations, but also they can be issued by governments, as I explained in one of my other first videos when I was giving the basics about finance. So why am I taking back bonds today? Because we're going to study topics that are a bit more complicated related to the bonds. And this is going to take me to talk about the yield, the spot rates, arbitrage opportunities, and other stuff that we'll start understanding. But for that, and in case you didn't watch my previous episodes, I'm going to go back to the basics of a bond. A bond will always have three elements. The first one is the face value. This is the value that's promised to you at the end of the maturity and is the value that you'll receive. Usually for calculations, we're going to consider face value as being 100 because this will allow us to create the price of the bond, but it's also just for the ease. You can buy bonds that are 100, 1,000, 10,000, whichever amount you want, but for simplicity, most models are going to be using 100 as the face value, as this is the value that's promised at the end. The second thing that you may also find in bonds is the coupon rate. And here, you have to be very careful because the coupon rate is not going to be the yield of the overall bond. The coupon rate is just telling you a percentage on which the bond will pay periodically coupons depends on what the bond says. It can be semi-annually most of the times, but it could also be annually, monthly, whatever you want to pay. So this one, the coupon rate, let's say if I have 6% coupon rate, that would mean that every year I'm paying 6. If we consider again that my face value was 100, we're going to apply the coupon rate into the face value, and that will give us the amount of coupons. But as I was telling you, usually government bonds will be semi-annually. So we're going to get instead two types of coupons, and this ones would be, for example, 3 and 3. If we continue with my example of a 6% coupon rate. So we already have face value, we already have coupon rate. What is the other important factor of a bond? This is going to be maturity. And maturity will give us when the bond expires. When is going to be the period that we'll receive our last coupon payment plus the face value of the bond. And then what we saw in the other videos is that you could bring back all of this with a yield that was usually given to us. And this would allow you to know the fair price of a bond. And it will also allow you to know if it was traded at a par, at a discount, or at a premium. And I'm not going to dive very deep into that, but if you remember, at a premium was when you were paying more than its face value, then at a discount when you were paying less than its face value, and then at par when you're paying the exact amount as the face value. So why am I going back to all of this? Let's start looking at what I want to teach you today, and it's the yield. So yield is going to be a measure for the return, the expected return that you're going to get from that bond. So this is going to be an accurate way of bringing all of that money into the present. So I may have a bond with a coupon, with face value, and with maturity, but I still don't know what is the fair price. For knowing the fair price, we'll need the yield. And also, if you have the yield, you can get a face value. So these are going to be two values that are all the time correlated. If you get one, you can get the other. If you know the yield, you can know the price now. And if you know the price, then you can get the yield. The thing is, it has a little caveat, because if we look at real life, we can't just say, oh, the yield for 10 years, it's going to be 3% or 8%. That would be a bit inaccurate, if we must say, especially looking at all of these years back.
look at 2023 and the returns it has given compared to 2022 or 2021 or 2020, where things were completely different. So we can't simply just calculate 1% for all of the points. What we have to do is create a yield that's a blend of spot rates. And this is a new concept. Spot rates are going to be, they are also called the zero coupon rate. Spot rates are basically the rates of the strips. The strips are bonds that pay no coupon. So you just buy the bond, you receive no coupon, but then, because they're very short, you also receive your money back with a percentage. Percentage is the spot rate. So, and here what we can use is mix all of the spot rates, and from that you can actually get the yield. So this process is going to be a bit more elaborate than what we were doing initially, but basically what it aims to do is take all of these different spot rates from many years, then take a fair price of the bond, but discounting each period with a different spot rate. Here's the trick. And then after you have all of that, then you'll be able to get the yield, right? Sounds kind of similar. So what if I knew the spot rates of any risk-free bonds that are for 1 year, 2 years, and 3 years? I can start discounting the coupon from year 1 with the spot rate of year 1. But then the coupon of year 2, I won't use it with this same spot rate. I'm going to use the spot rate of year 2. And then on year 3, which let's suppose was the maturity of my bond, I'm going to discount the coupon and the face value with that third spot rate. So you have a lot of math involved in this. It's going to be a bit of a longer process, but after you can discount all of that, you get a fair price. And what did I tell you at the beginning? If you have a price, you can get a yield. If you have the yield, now you can know what was the return overall of your bond throughout the years. So this, it's going to be the usual step because yields are bond specific. They apply to a bond, not to a time. If I get my specific yield, that would be from that bond. But spot rates are the ones that are time specific. These ones are going to be that apply for a time and not for a bond. We are mixing like two percentages. One of them, it's only the return of time, and that is going to give us the overall return of the bond. So first main important takeaway is that yields are going to be a blend of all the spot rates from all the years that you had your bond. But then what if we want to do it the other way around? What if I want to figure out what are the spot rates if I already have my yield? This is going to be a specific process that's called bootstrapping. And with the bootstrapping, you go the other way around. You start with your yield. So I know that I invested, for example, my mom invested this money in a bond this years ago, and it gave her this yield. But I want to know specifically which were the spot rates of each year. Well, for that, first, since we have the yield, we can bring the price, as I told you. And now for discounting the price, it's going to be harder because we have to do it year by year and see which are going to be those spot rates that were the ones that gave the specific price. So it's a bit of a longer process, but it's one that we usually may need to use if we have to compute the spot rates and we only have the yield. So you can get to either yields from spot rates or spot rates from yields. The thing you have to remember is that the middle point, it's always going to be the price, because price is one that connects these two that are supposedly different, because one is going to be related to bonds, the yield, and spot rates related to time. The price is going to be that meeting point for those two types of yields. And so all of this, you would imagine, why would someone do this? And the main thing is that yields, spot rates, all of this is going to show you, first of all, something that's important because it's the yield curve. And I have a very important episode where I brought a good guest from Toronto, and he's talking about his investigation on the yield curves And these are also called the spot yield curves. And it supposedly says that when yield curves from a country start getting inverted, so which is what's happening right now, any type of financial investment for 1 year and it will give me, let's say, 5% return. But if I get it for 3 years, it will give me only a 3% return. So right now it's higher, and then in many years it will be lower. This is drawing, let's say, a negative yield curve, but this, in proper terms of finance, you can never say that word for them. This would be called an inverted yield curve. And what Professor Campbell-Harvey said is that inverted yield curves are usually preceding recessions. So the fact that you have one doesn't mean that a recession's coming, but every recession has had one inverted yield curve before it. So this inverted yield curves are going to be very important for all the financial analysts to estimate how the stock market will behave, how the bond market will behave. And this is going to lead us to act in specific ways depending on what we think the financial environment will be. But so that's one of the first uses that we can use yield for. The second one would be considering of short selling and then maybe arbitrage opportunities. So there are two important concepts that I should explain before we dive into that, and it's the ask price is the price at which you buy, and then the bid price is the price at which you're selling something. And this is going to be when you trade any type of assets. But there's an important step on this, and it's that you can often short sell an asset. And this means that you're going to sell an asset that you do not own. So you're basically going to borrow the asset from someone else, typically through a broker. And then this is going to be in exchange of a small fee. And what you can do with that asset is that you can sell it in the market for the current price. And then in the future, you're going to buy the asset back and return it to its original owner. So why am I bringing up this right now? Because of the second concept that I wanted to mention, and it's arbitrage. Arbitrage in practice shouldn't exist because our markets are efficient, and so we shouldn't find opportunities to earn free money, let's say, which is what arbitrage offers. Arbitrage is when you buy or sell equivalent goods or portfolios, but you take an advantage of a difference. Something is glitching in the matrix, you can consider it. Something is wrong with the markets. And then something that should be with a fair price of $10 costs $8. So what should you do? You should always buy the cheap, sell the expensive. If you see this glitch, you should take it right away and you would have money at zero risk, which technically is impossible because the law of one price, so competitive markets with identical portfolios should have identical prices, but sometimes our markets are glitching. So if you find something that's mispriced, you could buy the cheap one and sell it automatically in the expensive way, and you will make that spread, the little bit part that's making it. So the arbitrage opportunity is that situation that you might find where it is possible to make profits without taking any risks. So of course, everyone wants to take advantage of this. In arbitrage, you can take it, for example, from bonds. If you find that a 10-year bond is giving you a yield at a price, and then the strips, which are the individual ones, are giving you the same yield but at a lower price, then that wouldn't make any sense, right? You should always see same pricing of things with similar portfolios. So if they're promising the same amount at the end, they should be costing the same amount today. But this may not be the case. And so the way to make use of those arbitrage opportunities, it's going to be easy. Just buy the cheap, sell the expensive. And this is a rule that you can use in any financial part in your life. But it's especially used in arbitrage. So if I see, for example, that the 10-year bond is more expensive than the individual strips, then I might want to buy all of the individual strips since they're the cheap ones, and then I'll sell them you can do this in the government. You can paste lots of strips and put them together into a like wider bond, let's say, and I could sell it as a 10-year bond if that would be the case. So all of this arbitrage forces are going to be very important, and that's why it's a good concept to know when you are looking at bonds, because in bonds you may see this arbitrage that you can buy strips or that you can resell things. So here you may be able to make profits at zero risk. The thing is that those ones are very short-lived, let's say this opportunities, because obviously the price will adjust as people start noticing and exploiting this arbitrage opportunities. And by exploiting it, you're also kind of making the market efficient. You're pushing the market towards a fair value, and all of the risk-free bonds are priced using one set of spot rates, because otherwise there would always be an arbitrage. So it might be a way of breaking something more complex into individual pieces and then doing it separately. On my next episode, I'll also start talking a little bit more deeper into stocks, which I had mentioned previously. So stay tuned for that one. I'll see you next week.